If you want to build a humanoid robot today, you can, just buy the silicon chip.
Right, the chips are everywhere.
Yeah, and you can write the generative AI software, and you can stamp the metal chassis in almost any advanced manufacturing hub in the entire world.
Exactly. That stuff is highly commoditized now.
But there is exactly one chemical bottleneck that is basically holding up the entire Western robotics and, frankly, the defense industry. And it all traces back to literally a single patch of dirt in California.
It is it's a really remarkable geopolitical and industrial reality. We are talking about the Mountain Pass facility, of course,
right,
and the company operating it, which is MP Materials. And when you look at their Q1 2026 earnings call, I mean, you realize you aren't just looking at a standard corporate ledger.
No, not at all.
You're really looking at the operational blueprint for the survival and the scaling of the entire Western advanced manufacturing supply chain.
And we are diving straight into the mechanics of that blueprint today. Welcome to another deep dive for Talk Tickers. And for those of you listening who know our format, we're going to break this down into 4 clear parts to make it super actionable for you.
Keep it data forward in plain language, like always.
Exactly. Yeah. So first, we'll hit the headline numbers, right? The revenue and the EPS. Second, we're going to unpack the story behind those numbers, which is all about this massive operational moat they're building.
The moat is the most fascinating part, honestly.
Absolutely. Then third, we'll look at management's guidance, what to expect in the coming quarters, and finally, the bottom line, our opinionated take on whether this is a bullish or bearish signal for anyone holding or even just considering the stock.
So let's just jump right into those headline numbers because they're honestly pretty jarring, especially in a heavy industrial sector that usually moves at, a glacial pace.
Yeah, heavy metallurgy is not known for explosive growth. But in the first quarter, their consolidated revenue and PPA income hit a combined $132.9 million.
Which is massive.
Right. That is a 28% sequential increase just from the fourth quarter of 2025.
Now, to really understand the weight of that number, you have to look at the core of their business, which is the materials segment.
The upstream side, right?
Exactly. The actual extraction and the initial processing out there in the dirt. That segment alone generated $114.5 million in revenue and PPA income.
Wow.
And that essentially doubles their performance from the exact same quarter last year.
100% growth in 12 months.
Yeah. When you see a heavy industrial company literally double a core revenue stream in a single year, it signals that their underlying infrastructure is it's finally catching up to the massive macro demand.
And you can see it flowing directly to the bottom line, too. They reported adjusted diluted earnings per share, or EPS, of 0.3.
Just 3 cents.
Yeah, and I know 3 cents per share might not, trigger some algorithmic buying frenzy the way a huge software beat would, right?
Right. It sounds tiny in isolation. But context is everything here. Because in Q1 of last year, they posted a 12-cent per share loss.
So that is a 15-cent swing straight into profitability.
Exactly, which is the critical data point for you as a retail investor. It proves that the unit economics of all their crazy scaling efforts are actually functioning.
Because growth is one thing,
yeah,
right? But profitable growth in heavy metallurgy is, it's exceptionally difficult to pull off.
Totally.
And they generated $36.6 million of consolidated adjusted EBITDA.
And for anyone newer to the jargon, that's earnings before interest, taxes, depreciation, and amortization.
Right. It basically strips out all the fancy accounting noise and just shows you the pure cash that their physical operations are spitting out.
Yeah.
And that cash generation is directly tied to the physical material they are successfully moving.
Okay, so let's talk about that physical material, because the production milestones are what really caught my eye in the transcript. They produced a record 17 metric tons of NDPR oxide.
Neodymium, praseodymium? Yeah. Exactly. NDPR. And look, we're going to get into exactly what that is and why it's arguably the most important physical material on Earth right now, but strictly numerically. That 17 metric tons is a 63% increase year over year.
But the sales volume was even more aggressive than the production. They sold 1,006 metric tons of NDPR oxide.
Okay, wait, this is where I have some pushback.
Okay, hit me.
If they only produced 17 tons, how on earth did they sell 1,006 tons? I mean, that math does not track at all unless they are pulling from some massive secret stockpile.
Well, you're right on the money. That disparity between production and sales volume in the physical commodities market is almost always a function of inventory management.
Oh, so it's just a timing thing.
Exactly, the timing of physical shipments. Their chief financial officer, Ryan Corbett, explicitly addressed this on the call. He said that as of March 31st, they had about 815 tons of NDPR, oxide, and metal moving through various stages of the supply chain.
Moving through the chain, like where?
It was either on hand, in transit, on rail cars or cargo ships, sitting at toll processors, or just, queued up for final delivery to the customer.
Okay, so let's clarify that real quick. A toll processor is essentially an outsourced facility that does a specific processing step for a flat fee, right?
Yes, exactly.
Like taking your raw wheat to a local miller to be turned into flour before you sell it to a bakery.
That's a perfect analogy. They still retain full ownership of the physical material. They just pay a literal toll for someone else's processing capacity. So they drew down heavily on that existing in-transit inventory to meet this massive surge in Q1 demand.
Got it. And alongside that refined oxide, they also had one of their strongest raw concentrate quarters, producing just under 13,000 metric tons of rare earth concentrate.
Right, so the production is clearly ramping.
The sales are surging, the operations are profitable. But this is but I'm looking at their balance sheet right now, and there is a number here that requires some serious scrutiny.
I think I know which number you're looking at.
Oh, you definitely do. They ended the quarter with $1.7 billion in cash and short-term investments.
The fortress balance sheet.
Yeah, management keeps throwing around that term, fortress balance sheet.
Yeah.
But look, we are in an environment where capital allocation is scrutinized heavily by the market. Holding $1.7 billion in cash during a period of high inflation is, well, it's basically lighting money on fire.
It definitely looks that way on the surface.
Right, because the purchasing power of that cash is degrading every single month. Why on earth are they hoarding all this instead of returning it to you, the shareholder, via a special dividend or, I don't know, a massive share buyback program?
It's a completely fair challenge. And honestly, if this were a mature consumer packaged goods company like a Coca-Cola or something, you would be absolutely right to demand a dividend.
Exactly.
But you have to view that $1.7 billion through the lens of extreme industrial capital intensity. MP Materials is attempting something that, frankly, hasn't been done in the Western Hemisphere in decades.
Which is what?
They are building a fully integrated, deep tech supply chain from the bedrock up.
But $1.7 billion. I mean, that's the GDP of a small island nation just sitting in short-term paper.
And the reality is they are going to need almost every single penny of it. We have to look at their capital expenditure run rate, which we'll detail more when we hit guidance later, but they are projecting $500 to $600 million in CapEx for this year alone.
Okay. Wow. $500 million a year.
Right. At that burn rate, a $1.7 billion cash pile is essentially just a 3-year runway if the macro environment suddenly tightens.
Oh, I see.
By holding this cash, they have completely insulated themselves from the debt markets. If interest rates spike again, or if credit markets suddenly freeze up,
Deere Materials doesn't care.
they don't care at all. They don't have to go beg the banks and accept predatory interest rates, and they don't have to dilute their existing shareholders by issuing secondary stock offerings to fund their new factories.
So it isn't just a mattress they're hiding money under.
No, it is a highly strategic weapon. It guarantees their massive expansion will not be interrupted by external financial shocks.
Okay, I see the logic. In a capital-intensive industry, whoever has the longest uninterruptible runway wins. You really don't want to halt construction on a billion-dollar refinery just because the commercial paper market had a bad week.
Exactly. It's an insurance policy for completion.
I will concede the fortress balance sheet point then.
Yeah.
But I want to dig into how they're actually pricing the material they're selling. Because the CFO threw around some Wall Street jargon on the call that we desperately need to translate.
Oh, the PPA stuff.
Yeah, he kept referencing PPA income and $110 per kilogram floor. Let's break down the actual mechanics of this for the listener. What exactly is a production payment agreement, and how does it function in the physical commodities market?
So a PPA, or production payment agreement, is essentially a highly structured financial hedge. It's designed to provide strict downside protection in what is inherently a super volatile market.
Because commodity prices swing wildly, right?
Wildly. If you are mining and refining rare earths, the global spot price of NDPR can fluctuate violently based on macroeconomic shifts, sudden demand surges, or, and this is the big one, strategic dumping by foreign competitors who are just trying to price you out of business.
So theoretically, if the global price collapses tomorrow, MP Materials could end up selling their product for less than it actually costs to pull it out of the ground.
Historically, yes. That exact dynamic is what has bankrupted almost every other Western rare earth operation in the past.
Wow, okay.
But MP Materials structured agreements with their key partners where they are contractually guaranteed a minimum floor price for their NDPR. And in this specific agreement, that floor is hard-coded at $110 per kilogram.
Okay, wait, so even if the spot market price of NDPR drops to, let's say, $80 a kilogram, MP Materials still walks away with $110.
Precisely. It de-risks the entire revenue stream. Now, the mechanics of how this income actually gets recognized on their balance sheet involve a built-in time lag. Ryan Corbett explained that their realized pricing for the second quarter is projected to be in the low to mid-90s per kilogram.
Wait, I'm confused. If the floor is guaranteed at $110, why are they recognizing pricing in the low 90s?
Because of market lags. The contracts they've signed generally price their physical shipments based on an approximate 1 quarter or 90-day lag to the prevailing market prices.
Oh, I understand. It's kind of like locking in a mortgage rate. Like you might close on the house today, but the financial reality of that transaction was actually dictated by the interest rate environment from 60 or 90 days ago.
That's spot on. The market moves, but your current contract is anchored to the immediate past. So they are recognizing the depressed market prices from the previous quarter. But this is exactly where the PPA steps in to save the day. Because their realized price from the lagging market is in the low 90s, the production payment agreement triggers, and they receive supplemental PPA income that financially bridges the gap between that low 90s realized price and their guaranteed $110 floor.
That is incredibly advantageous for the retail investor holding this stock.
Mm-hmm.
You don't have to obsessively check the spot price of rare earths every morning over your coffee because management has already built a mathematical floor right underneath the company's profitability.
It completely smooths out the volatility. It ensures that their cash generation remains totally predictable even when the broader commodity markets are chaotic.
Which is huge for planning those $500 million CapEx projects.
Exactly. However, Corbett did introduce one really important operational nuance on the call. As their midstream refining operations ramp up capacity, they are taking the raw rare earth concentrate that they use to stockpile and sell, and they're starting to feed it directly into their own refinery.
Oh. They're consuming their own raw materials to make higher value products.
Right. And because the volume of available concentrate for stockpiling is declining, and because current market prices remain relatively close to or above their floor, the CFO explicitly stated they do not expect to generate a material amount of PPA income, specifically from stockpiled concentrate in the coming quarters.
So the financial training wheels are kind of coming off.
A little bit, yeah. But only because the underlying business is transitioning to a much more advanced, significantly higher margin phase of operation.
Which brings us perfectly to the second part of our deep dive, the operational moat of the company. A fortress balance sheet and a pricing floor are, fantastic defensive tools. But to understand why MP Materials is so critical to the whole tech sector, we have to look at their offense.
Yes, their strategic advantage is insane.
We need to look at this massive moat they're building, which centers around a concept they call the binding constraint.
Right, and to grasp this, you really need an understanding of their vertical integration strategy, because MP Materials is not just trying to be a single link in the supply chain.
Right, they want the whole chain.
Exactly. They are engineering the entire chain from start to finish, completely insulated from foreign reliance. And the strategy is built in 3 distinct stages. First, you have the upstream operation at Mountain Pass, California. That's the brute force extraction of the raw ore right out of the earth.
And then second, you have the midstream operations. Right, this is the highly complex chemical refining process where they take that dirt and they separate out the extremely valuable individual elements, like NDPR.
Right. And third, you have the downstream operations, which is their magnetics division. They currently have a facility they call Independence, and they are actively building a massive next-generation facility that they've named 10X.
Independence and 10X, those naming conventions are highly deliberate, aren't they?
Oh, absolutely. Independence signals the severing of their reliance on international supply chains for critical defense components. And 10X signals their intent to scale the business exponentially. But the reason this 3-stage vertical integration is so impenetrable as a competitive moat It all comes down to the brutal reality of industrial metallurgy. During the Q&A portion of the earnings call, an analyst asked the CEO, Jim Litinsky, about this sudden influx of competitors who are announcing plans to build their own Western magnet factories.
Oh, yeah. And Litinsky's response to that was illuminating. It was arguably the most important quote of the entire call.
I agree completely.
He referenced Jeff Bezos' famous business maxim, right? Your margin is my opportunity, which basically dictates that Amazon will aggressively undercut a competitor's high prices just to steal all their market share. But Litinsky inverted it.
He coined the Litinsky corollary.
The Litinsky corollary. I love it. He looked at all these competitors rushing to build shiny new magnet factories, and he said, your investment is our opportunity.
It is a statement of supreme strategic confidence. I mean, Litinsky is watching all these well-funded competitors announce greenfield projects, these massive new manufacturing plants designed to just stamp out permanent magnets, and he is welcoming them with open arms.
Why? Why would he welcome competitors?
Because he understands the fatal flaw in all of their business models.
Let me guess. They don't have the dirt.
They don't have the dirt. And more importantly, they don't have the midstream chemical separation infrastructure to process the dirt, even if they miraculously found it.
Wow.
Litinsky outlined the harsh truth of the mining sector. You can look at a geological survey and identify a rare earth deposit. An analyst can build a really pretty spreadsheet multiplying the estimated tonnage by the current spot price and declare a future billion-dollar valuation.
But culling a rock out of the ground is, what, maybe 10% of the battle?
Less than 10%. The real bottleneck is permitting a new mine in a Western country, developing the incredibly complex chemical recoveries, managing the severe environmental and regulatory challenges of running a high-temperature separation circuit, and then actually scaling it to commercial viability.
So years and years of red tape and engineering nightmares.
Exactly. Litinsky estimated that if a competitor somehow found a comparable resource to Mountain Pass today, replicating MP's industrial capability would require massive amounts of capital and well over 5 years of grueling, delay-ridden development.
So when Litinsky says, your investment is our opportunity, he literally means he wants these competitors to spend hundreds of millions of dollars building empty magnet factories.
Yes, because the day those factories finally open, they're going to realize they have absolutely no raw materials to feed their brand new assembly lines.
And if they want non-Chinese supply to meet defense requirements or ESG goals, they will be forced to come crawling right to MP Materials to buy the refined NDPR oxide.
Exactly. MP doesn't have to take the capital risk of building every single magnet factory in Europe and North America. They just have to operate the sole toll booth that every single one of those factories absolutely must pass through.
That is brilliant. And we have hard data from the transcript to quantify exactly how powerful that toll booth is going to be, right?
Yeah. Yes. Litinsky directed the analysts to a report by Atomus Research during the call. The data projects that over the next 18 to 24 months, non-China magnet manufacturing capacity is going to scale up to roughly 60,000 tons. And over a 5-year horizon, it's projected to push toward 100,000 tons.
100,000 tons of newly built manufacturing capacity that is starving for raw material. But where is all that material supposed to come from?
That is the multi-billion-dollar question, because currently there are really only 2 scaled providers of refined NDPR outside of China, MP Materials and an Australian producer named Lynas.
But didn't Litinsky point out during the call that Lynas's output is essentially entirely locked up?
Yes, exactly. The Japanese government and Japanese industry have aggressively secured nearly the entirety of Lynas's future production under long-term strategic arrangements just to protect their own automotive and electronic sectors.
Which leaves MP Materials standing alone in an empty room, holding the keys to the entire remaining Western market.
Yep. And Litinsky provided a fantastic rule of thumb to help investors model this out. He stated that producing 10 tons of finished rare earth magnets requires approximately 1 ton of NDPR oxide feedstock.
Okay, so the math is incredibly straightforward for the listener. Yeah. If the Western world builds 60,000 tons of new magnet capacity, the supply chain instantly requires 6,000 tons of newly refined NDPR oxide just to turn the machines on.
Exactly. And Litinsky explicitly used the term binding constraint to describe this. He stated that access to NDPR oxide will absolutely remain the binding constraint for any economically viable rare earth magnet production outside of China for at least the next half-decade.
A binding constraint. In industrial engineering, a binding constraint dictates the maximum possible velocity of the entire system, right?
Yes. You can build 50 new electric vehicle chassis factories, but if there's only enough NDPR to build motors for 10 cars, your entire system output is exactly 10 cars. NDPR is quite literally the binding constraint of the modern automated economy.
Which brings us to the macroeconomic forces driving this truly insatiable demand. Because this isn't just about consumer electronics and iPhones anymore. During the Q&A, an analyst asked management about how recent geopolitical events in the Middle East were impacting customer demand timelines.
Right.
And just to be completely clear, for you, the listener, we are looking at this strictly through the lens of supply chain mechanics and market demand catalysts as they were presented in the earnings call. We are impartially analyzing the industrial reaction to these conflicts. We aren't taking any political stance on the conflicts themselves.
Understood. And the analysis provided by Litinsky is that the protracted conflict in Ukraine, alongside the escalating tensions in the Middle East, have triggered a fundamental, permanent paradigm shift in Western military doctrine.
How so?
Well, global defense departments have seemingly recognized that the future of warfare is no longer exclusively about massive, multi-billion-dollar aircraft carriers or these exquisite, incredibly slow-to-produce stealth bombers.
He used a phrase that honestly paints a stark picture of the future. He said it is highly likely that future conflicts will involve, quote, millions, if not eventually billions of robots and drones working in cohesion.
Yeah, we're talking about massive drone swarms, fully autonomous perimeter defense systems, loitering munitions. And what is the one physical component that every single one of those millions of drones absolutely requires to function?
High performance, rare earth, permanent magnets. They're required for the navigation systems, the complex sensor arrays, and obviously the physical motors that actually drive the rotors.
Exactly. Litinsky noted that the recognition of rare earth magnetics as a critical national security industry was already present in defense circles, sure, but the sheer volume of drone deployment in recent global conflicts has violently pulled the whole timetable forward.
It's an accelerant.
It is a massive structural demand accelerant that is completely divorced from standard consumer economic cycles. It doesn't matter if there's a recession, defense spending on these swarms is going up.
And that autonomous revolution isn't confined to the military either. We really have to talk about what is happening in the commercial sector right now with the rise of what they call physical AI.
Oh, this is fascinating.
We have all spent the last 2 years watching generative AI text and image models evolve at breakneck speeds. But physical AI is the next real frontier. It is the process of taking that advanced neural network brain and putting it inside a physical robotic body.
We are looking at the imminent deployment of humanoid robots designed for warehouse logistics, hazardous environment work, and full-scale factory floor automation.
And this is where the earnings call revealed a really fascinating nuance regarding the material science of these machines. When we talk about rare earths, I think the market tends to just lump them all together, but they're very different elements.
Right, they aren't all the same.
You have the light rare earths, primarily NDPR, which provide the raw magnetic force. But historically, if you wanted to make a magnet resistant to the extreme heat generated inside an industrial motor, you had to add heavy rare earths, specifically elements like dysprosium and terbium.
And those heavy rare earths are notoriously expensive. They're incredibly difficult to separate, and they are almost entirely sourced from highly concentrated, geopolitically risky regions.
But Jim Litinsky made a really bold prediction on the call. He expects the demand for NDPR to continue its explosive upward trajectory, but he actually predicted that the global prices for the heavy rare earths, the dysprosium and terbium, might experience a substantial price drop over time.
Which seems completely counterintuitive until you factor in human ingenuity. The technology industry recognizes the heavy rare earth bottleneck, and they are actively engineering their way right around it. Yeah, MP's chief operating officer, Michael Rosenthal, corroborated this exact trend. He stated that MP's product development teams are aggressively advancing new magnet grades for these robotic applications that feature materially reduced, and some cutting-edge instances, absolutely zero heavy rare earth content.
They are engineering heavy free magnets for physical AI.
Yeah.
I mean, that is a monumental leap in material science. It means the foundational constraint, the light rare earth NDPR, becomes even more critical, but the expensive, geopolitically risky, heavy additives are just being systematically designed out of the motor blueprints.
And MT Materials is not just a passive beneficiary of this trend. They are actively driving the fundamental research.
Yeah.
By developing the metallurgy to make heavy free magnets economically viable, they are accelerating the adoption curve of humanoid robotics.
So, as Litinsky summarized, if you listen to the leading technologists in the world today, advanced rare earth magnetics are viewed as the co-equal physical constraint, right alongside the silicon semiconductor chips required to make a roboticized economy an actual reality.
Exactly. So if we pull back and look at the whole board here, MP Materials has a $1.7 billion cash fortress protecting them from the capital markets.
Yep.
They have a vertical integration strategy that competitors are literally underestimating by a half decade. They control the mathematical binding constraint for all Western magnet manufacturing, and they are riding the dual unstoppable macroeconomic tailwinds of autonomous defense swarms and commercial physical AI.
I mean, the narrative is flawless. It sounds like a sure thing, but transitioning from a flawless narrative to physical, heavy industrial execution requires navigating a brutal gauntlet of engineering and financial hurdles.
And that transition is exactly what management's guidance focused on. This is part 3 of our deep dive. We need to look very, very closely at what they're forecasting for the immediate future, because it involves navigating what I would classify as severe financial lumpiness and really intense engineering risks.
Financial lumpiness. I love that. It is the perfect term for a stock chart that is about to look highly erratic to an uneducated trader. Let's start with the most immediate headwind they explicitly warned investors about. In the upcoming second quarter, Q2, management guided for a short-term production dip.
Right.
They stated that NDPR oxide production will experience a single-digit sequential decline. Now, if I am a retail investor and I just heard you tell me they hit record-breaking production of 17 metric tons in Q1, seeing a forecasted decline for the very next quarter is going to trigger my reflex to hit the sell button. Why is production dropping right when demand is surging?
Because in heavy industry, you sometimes have to completely shut down the engine to install a supercharger. This dip is not a structural failure.
Okay, September.
It is not a sign that the ore grade at Mountain Pass is somehow degrading, and it is not a failure of their workforce. It is a highly choreographed, fully planned operational pause. The COO, Michael Rosenthal, explained that they successfully concluded a major semi-annual maintenance outage in April.
But more crucially, he said the slower resumption of their normal production run rate is tied directly to the installation and commissioning tie-ins for their brand new heavy rare earth separation circuit, right?
Yes.
Okay, let's explain the physical mechanics of a commissioning tie-in to the listener, because that sounds very technical. What does that actually look like on the ground?
Imagine an active, massive chemical refinery. It is a labyrinth of pipes, huge tanks, and continuous flows of highly corrosive, high-temperature liquids.
Sounds dangerous.
Very. Now, they have just spent months building a brand new, highly complex circuit specifically designed to separate heavy rare earths. But that shiny new circuit is totally useless until it is physically connected to the existing flowing veins of the main refinery.
You can't just slap a piece of duct tape on a pipe carrying corrosive chemicals at 200 degrees.
Exactly. A commissioning tie-in requires them to carefully bring the temperature and pressure of the active systems way down, physically cut into the existing infrastructure, weld and seal the massive new valves and junctions, and then slowly, painstakingly test the pressure and flow rates as they bring the entire integrated system back online.
Because if you rush it, you risk catastrophic chemical spills or permanent equipment damage.
Right. It requires a controlled reduction in overall output. It is a deliberate step backward in Q2 to take a massive leap forward. Because once those tie-ins are secure, they are projecting aggressive sequential growth. By Q3, they expect production to surge, and they are targeting a massive 500-ton per month run rate of NDPR production by the end of the calendar year.
It's like the industrial equivalent of shutting down a major highway for a weekend to pave 3 new lanes. The traffic jam on Saturday is absolutely brutal, but by Monday morning, the throughput capacity of the system has permanently increased.
That's a great way to look at it.
And paving those new lanes is not cheap. Let's look at the capital expenditure guidance, because it is staggering. Ryan Corbett reiterated that they expect full-year CapEx to land between $500 and $600 million.
Yeah, a massive portion of that $500 million is being deployed because they recently acquired the real estate, broke ground, and are aggressively accelerating the construction of their 10X magnet facility.
Which circles perfectly back to my earlier pushback on their $1.7 billion cash position. When you have a $600 million annual capital outlay, you realize the cash pile is literally the only thing standing between MP Materials and crippling corporate debt.
Exactly. They're fully funding this aggressive, multi-year capacity expansion directly from their own balance sheet, supplemented by the operating cash flow from the upstream mine.
But I want to introduce some skepticism here regarding how they are actually deploying that capital. They have the first downstream magnet facility, Independence, which is currently ramping up. To me, building Independence sounds like a team of engineers building a prototype car.
Okay, I follow.
You are figuring out the physics of bending the metal alloys, how to wire the control systems, and how the chemical tolerances react at scale. Now, they are pouring hundreds of millions of dollars into 10X, which is essentially the massive assembly line designed to mass produce that prototype.
Yes.
Moving from a functional prototype to reliable mass production is famously the exact valley of death, where hardware and deep tech startups go bankrupt. Aren't they going to bleed massive amounts of cash trying to figure out how to scale this highly temperamental manufacturing process?
It is arguably the highest risk phase of their entire corporate life cycle. Scaling complex metallurgy is exponentially more difficult than, say, writing software. But management confronted this exact risk during the call.
What did they say?
An analyst probed on how the lessons learned from the Independence facility would actually translate to 10X. The response centered around a concept they call copy and paste engineering.
Copy and paste engineering. Honestly, that sounds dangerously simplistic for building a next-generation robotics magnet factory. Explain the Heyshao W behind that.
Well, it isn't literal copy and pasting. It is the aggressive application of hard-won institutional knowledge. Michael Rosenthal detailed how the last couple of years spent designing, building, and ramping the Independence facility provided a brutal, expensive, but ultimately invaluable education for their engineering teams.
So when they sit down to design the flow sheets for the 10X facility, they are not starting from a blank whiteboard.
Precisely. They have established battle-tested vendor relationships now. They know exactly which specific brands of industrial pumps fail under the corrosive stress of the chemical slurry, and which ones actually hold up.
They know the exact thermal tolerances required for the sintering ovens.
Exactly. By leveraging this proprietary knowledge, the design and procurement process for 10X will be vastly faster and significantly less prone to the expensive change orders, equipment rework, and downtime that plagued their very first attempts.
Essentially, they have already paid the stupid tax on the Independence facility, and they refuse to pay it again on 10X.
That's a perfect way to put it. And because the physical engineering teams can actively travel and communicate between the operational Independence site and the 10X construction site, the operational know-how transfers directly.
Right.
Jim Latinsky added that the process of building their technical team and mapping the global intellectual property landscape over the last 3 years means they are executing the 10X build with a level of sophistication and foresight that simply did not exist when they first broke ground on Independence.
Which brings up a critical acronym from the guidance that retail investors desperately need to understand because it dictates exactly when the real money starts flowing. The CFO stated that progressing through the PPAP process is the key to unlocking major revenue on the finished magnet side. What exactly is a PPAP, and why is it holding up revenue?
PTAP stands for Production Part Approval Process. It is a brutally rigorous, highly standardized validation protocol utilized primarily by the automotive and aerospace industries. When MP Materials announces a contract to supply permanent magnets to General Motors or Apple, it is not a simple transactional relationship. You don't just, mail Tim Cook a magnet, ask if he likes the magnetic pole, and wait for a check.
Right, because it's not a simple consumer product. You are supplying a component that dictates the safety and functionality of a 4,000-pound vehicle going 70 miles per hour down the highway, or a precision piece of consumer electronics.
Exactly. It is essentially a forensic audit of your entire manufacturing capability. The customer, whether it's GM for EV motors or Apple for haptic engines, requires MP Materials to definitively prove that they can manufacture the exact magnet to precise microscopic and chemical specifications with absolute consistency at massive commercial scale.
And crucially, they have to prove they can do it using the final commercial production equipment, not just handcrafting it in a pristine laboratory environment.
Because making one perfect magnet in a lab is relatively easy, making 1 million perfect magnets on a dusty factory floor is a monumental engineering challenge. GM isn't just buying the physical magnet, they're buying the mathematical certainty that the 1 millionth magnet coming off the line will perform identically to the very first one.
Wow.
Exactly. MP has to define and submit a granular quality management plan, run continuous production at high stress rates, and then the customer takes those validation parts and subjects them to extreme real-world testing. We're talking thermal degradation, intense vibration, and long-term demagnetization stress. It is a multi-quarter gauntlet.
And while MP Materials is running that PPay gauntlet, they are trapped in a financial gap that creates the lumpiness we talked about earlier. Let's look at the specific revenue numbers this CFO provided. Corbett noted they currently have about $62 million in prepaid revenue sitting on the books waiting to be recognized.
Right.
This is cash they previously received from selling magnetic precursor products, essentially the intermediate, semi-refined materials that sit between raw ore and a finished magnet.
Correct. But here is the massive strategic pivot. As they transition their business model from selling those lower margin intermediate precursors to manufacturing and selling the final high margin finished magnets, that $62 million in prepaid revenue is going to slowly roll off the income statement over the next 4 quarters on a declining basis.
And once that specific prepayment obligation is fully met, MP Materials will completely cease producing precursor products for external sale.
Because they need all of that intermediate material for themselves. They are taking their own medicine. Instead of selling the flour to a bakery, they are using all the flour to bake the bread themselves. They're dedicating 100% of their metal production capacity to feed their own downstream magnet lines.
Okay. But there is a temporal mismatch between when the old revenue stops and the new revenue begins.
Precisely. The precursor revenue is going to bleed off sequentially over the next 4 quarters. However, due to the lengthy PP validation timelines we just discussed, they do not expect the initial wave of finished magnet revenue to begin hitting the income statement until the second half of 2026.
And even then, it will start with modest delivery volumes as the automotive assembly lines ramp up.
Right. So for the next 3 to 4 quarters, the top line revenue might look completely stagnant or potentially even decline slightly, even though the underlying physical business is undergoing a massive, highly accretive transformation.
The whole factory is being retooled. And to a short-term stock trader looking strictly at a 90-day chart, a factory retooling just looks like a stalled business.
Which serves as the perfect mechanism to transition into our final synthesis, part 4, the bottom line.
This is the crux of the Talk Tickers philosophy. We have analyzed the raw numbers, the operational moats, the material science, and the macroeconomic catalysts. Now, we must synthesize this data into an actionable, highly opinionated takeaway for you, the retail investor trying to decide how to position your portfolio.
Let's construct the synthesized bull case first.
Okay, so first, the foundation is impregnable. A $1.7 billion cash fortress guarantees their survival and fully funds their massive $600 million annual capital expansion without the need for toxic debt or shareholder dilution.
Second, the PPA agreements provide a legally binding $110 per kilogram floor on their pricing, structurally insulating their cash flows from sudden commodity market crashes.
Third, they have secured massive financial validation from the most rigorous corporations on Earth. They received a $32 million prepayment from Apple just in February, bringing Apple's total prepayment commitment to $72 million.
Yeah, a company like Apple does not hand over $72 million in advance unless they have exhaustively audited the supplier's capability and deemed them absolutely vital to their hardware roadmap.
And fourth, they possess a virtual monopoly on Western NDPR feedstock, that binding constraint we talked about for at least the next half decade, while competitors struggle with the reality of 5-year permitting and metallurgy timelines.
Looking at this data, I will take a definitive stance. The long-term setup for MP Materials is exceptionally bullish. They are actively positioning themselves not merely as a participant in the rare earth space, but as the foundational keystone of the entire Western advanced manufacturing and defense economy. However, the actionable advice comes with a massive caveat. Investors entering the stock need an iron stomach for the next 12 to 18 months.
The financial lumpiness is going to shake out the weak hands, isn't it?
Without question. The transition from recognizing precursor revenue to completing the grueling PPay validations for finished magnets is going to really test the patience of Wall Street. Institutional analysts are overwhelmingly incentivized to operate on strict 90-day performance cycles.
Right. They want immediate results.
So when that $62 million in precursor revenue rolls off, and the top line growth appears to flatten while they await the green light from Apple and GM, Short-term algorithmic traders and impatient funds might panic. They will likely sell off the stock because it isn't delivering immediate quarter-over-quarter dopamine hits.
But if you understand the underlying mechanics of a PP validation, you know that a flat revenue line during that period is not a sign of failure. It is the sound of a coiled spring compressing. But wait, there is one final, incredibly bullish data point regarding their expansion strategy that we haven't even explored yet. And it might be the most crucial element of their long-term moat. It revolves around their supply chain intellectual property.
This was a brilliant strategic insight offered by Jim Litinsky during the Q&A. When MP Materials first made the commitment to build a fully Western, non-Chinese magnet supply chain, they recognized a glaring structural hypocrisy in the broader market.
Which is?
Well, it makes absolutely no strategic sense to spend billions of dollars building an independent Western supply chain if that entire chain relies on Chinese manufactured industrial equipment to function.
Right. If the goal is sovereign independence, you cannot source the vital calibration tools, the specialized high-temperature ovens, and the chemical pumps from the exact nation you were trying to decouple from. Because the moment geopolitical tensions flare, they cut off your spare parts, and your billion-dollar Western factory just grinds to a halt.
Exactly. So MP Materials took the harder path. They spent years developing and enforcing a strict non-China equipment sourcing strategy. It undoubtedly required more upfront capital, it was harder to engineer, and it caused initial delays, but it guarantees absolute, impenetrable supply chain security.
Furthermore, their goal is not simply to achieve parity with international competitors. They aren't trying to build a Western copy of a Chinese magnet factory. They are leveraging novel intellectual property to technologically leapfrog the global market.
Yes. Litinsky specifically highlighted their mastery of a technology called grain boundary diffusion.
Okay, let's explain the HOW behind that technological leapfrog. What is the specific material science edge they are deploying here?
To understand grain boundary diffusion, you have to picture the microscopic crystal structure of a permanent magnet. Historically, to prevent a magnet from demagnetizing when a motor gets incredibly hot, manufacturers would literally bake expensive, heavy rare earths like dysprosium and terbium throughout the entire mixture of the magnet.
It is incredibly wasteful, but it works.
It's like building an entire house out of fireproof titanium just to keep the kitchen safe.
That is a great way to visualize it. So what does grain boundary diffusion do differently?
Grain boundary diffusion is a next-generation manufacturing technique that changes the architecture entirely. Instead of mixing the heavy rare earths throughout the entire bulk of the magnet, they take a finished NDPR magnet, coat the outside with a microscopic layer of the heavy rare earth, and then use highly controlled thermal ovens to diffuse that heavy element strictly along the borders, the grain boundaries of the internal crystal structure.
So they are essentially creating a targeted, heat-resistant microscopic skeleton inside the magnet while leaving the bulk of the interior purely NDPR.
Precisely. This technique massively increases the heat resistance and performance of the magnet while reducing the amount of expensive dysprosium and terbium required by upwards of 80%.
Whoa, 80% reduction.
Yeah. It is the exact scientific mechanism that enables the creation of the heavy-free and reduced heavy magnets demanded by the physical AI and robotics industries we discussed earlier.
That is a phenomenal explanation. By mastering grain boundary diffusion and mapping the patent landscape around it, MP isn't just scaling up a bigger factory. They are actively writing and owning the proprietary manufacturing IP of the future.
Right. Litinsky stated his explicit goal. When the 10X facility fully comes online, MP Materials intends to be the absolute best magnet maker in the world, judged on technological superiority, not just geographic location.
So synthesizing all of this into direct, actionable guidance for you, the listener, do not let the upcoming telegraphed volatility shake you out of a highly strategic position. When Q2 earnings arrive and production shows a sequential dip, do not panic.
You know the exact mechanics of why it is happening. They are intentionally throttling the system to safely tie in the massive new heavy rare earth separation circuit.
And when top-line revenue looks sluggish over the next 4 quarters, do not panic. You know they are deliberately rolling off precursor sales and hoarding their own material to feed the infinitely more profitable finished magnet lines.
If you are an investor with a multi-year time horizon, the financial lumpiness of the next 12 to 18 months should be actively viewed as a potential accumulation zone. The broader public market is historically terrible at pricing in complex multi-year industrial transitions.
The key is to detach from the 90-day algorithmic noise and keep your eyes fixed on the late 2026 and 2027 horizon. That is the moment the rigorous PPP automotive validations conclude, the Independence facility reaches full utilization, and the high-margin finished magnet deliveries to Apple, General Motors, and the global defense contractors begin scaling in earnest.
And that is the exact timeline when the massive 10X facility starts spinning up to meet the demand of the humanoid robotics boom. That is the physical reality you're investing in. Let's briefly formalize the 4 core takeaways from this deep dive into the MP Materials Q1 2026 earnings call.
Okay, number 1, they possess a $1.7 billion cash fortress and record production metrics, proving their underlying unit economics are highly profitable and financially secure against macro shocks. Number 2, they control the absolute industrial bottleneck, the refined NDPR feedstock that every competing Western magnet manufacturer desperately requires to operate over the next 5 years.
Number 3, investors must mentally and financially prepare for short-term financial lumpiness. The transition from selling precursors to executing complex PPP validations for finished magnets will obscure the massive value creation happening under the surface. And number 4, through their non-China equipment sourcing and proprietary grain boundary diffusion IP, they are positioned as the ultimate long-term bullish play on the physical hardware required for defense swarms, automation, and physical AI.
Which brings me to a final provocative thought that I want every listener to deeply consider before we wrap up today. Throughout this entire conversation, we have repeatedly used the terminology of extraction. We referred to MP Materials as a mining company.
Because the broader financial market indexes them alongside traditional miners. Wall Street analysts compare their financial metrics to copper extractors, lithium evaporation ponds, and gold diggers.
And if you look strictly at their historical operations at Mountain Pass, just pulling ore out of the ground, that classification was factually accurate.
It was.
But if we look at the reality of the blueprint we just unpacked, if they are actively becoming the sole mathematically indispensable provider of the physical hardware required to make an autonomous humanoid robot function, if they are the critical chemical link that allows advanced next-generation defense drone swarms to navigate and operate, and if they are actively writing their own proprietary cutting-edge manufacturing IP using grain boundary diffusion to technologically leapfrog the rest of the world.
It forces a profound reevaluation of their valuation multiples. A mining company trades at a low multiple because they are a price taker selling a generic commodity. A deep tech monopoly trades at a massive premium because they own the future.
Exactly. The question isn't whether MP Materials is a good mining company. The question is, are we mispricing them by an entire order of magnitude? Should MP Materials actually be valued as a deep tech AI and defense contractor, rather than a company that just digs rocks out of the ground?
If the trillion-dollar generative AI software of the future requires a physical body to interact with the real world, MP Materials is quite literally building the skeleton.
It is a fundamental shift in corporate identity. And the financial markets, for all their speed, are notoriously slow to recognize when heavy industry transforms into high technology. And when that realization finally hits the broader market, the repricing of the stock could be violent. Thank you for joining us for another intensive deep dive. Take a hard look at your own portfolios this week. Check your high-flying software, robotics, and defense stocks, and ask yourself a simple, uncomfortable question. How entirely dependent are their futuristic revenue promises on the success of this single, complex supply chain in California? Until next time, remember that the most valuable actionable insights aren't found in the headline beats or misses, but in the muddy, highly technical waters of the operational blueprint. Keep digging into the data.